You might want to try this one strategy to avoid capital gains taxes. Hear me out. So one of our viewers, she's over 70 years old. 5 years after her husband died, she sold her house to downsize. She took all the equity and put it in another property. A couple years after that, she got audited and got hit with capital gains taxes. Now she has to work a part-time job just to pay these taxes off in her 70s. What she should have done is sold the house within the first 2 years so she can get that $500,000 exemption. And if there's any capital gains after that, she can take the money and put it in something called a deferred sales trust.
And what she also should have done was to make sure to account for the step-up in basis when her spouse died. And the step-up in basis will depend on whether or not she's in a community property state. If she's not in a community property state, she'll get a step-up in basis in half the value of the property. If she's in a community property state, then as long as that asset was community property, she'll get a step-up in basis of the full amount of the asset. And remember, the implementation is up to you as the taxpayer. So it's up to her to make sure she gives that information to her accountant and gets it on her return. Otherwise, a lot of times people just put the wrong basis and pay more in tax than they should. And for actual tax law from a tax attorney, subscribe.